Hey everyone, welcome back to the channel. Today we're diving into a topic that's been making waves in the financial world: why foreign institutional investors, or FIIs, have been selling off Indian stocks. Now, if you're invested in the Indian market or thinking about it, this is something you definitely want to pay attention to. We're talking about big money flowing out, and it's crucial to understand why. So buckle up, grab your chai, and let's break it down. One of the biggest factors at play here is the falling Indian rupee. You see, when the rupee weakens against the US dollar, like it has been recently, it makes investing in India less profitable for foreign investors. Think about it. They're converting their dollars into rupees, investing in Indian companies, and then, when they want to cash out, they have to convert those rupees back into dollars. If the rupee's value has fallen in the meantime, they end up losing money, even if the stock itself has gone up. It's like buying a delicious samosa for 100 rupees, then coming back later to sell it for 150 rupees, feeling proud of your profit. But then, you realize the exchange rate has changed, and those 150 rupees only get you $1.50 back when you originally spent $2. It's frustrating, and it's making some FIIs hesitant to stay invested. Meanwhile, over in the US, things are looking a little different. US Treasury bonds, which are considered super safe investments, are offering really attractive yields right now. We're talking about the highest returns we've seen in years. So, naturally, FIIs are looking at these yields and thinking, hey, maybe I can make more money with less risk by putting my money into US bonds instead of Indian stocks. And who can blame them? It's like choosing between a plate of samosas from your favorite street vendor or a guaranteed delicious buffet at a fancy restaurant. The samosas might be amazing, but the buffet offers more variety and a sure thing. That's the kind of decision FIIs are facing right now. Now let's talk about valuations. Compared to other emerging markets around the world, some experts believe that Indian stocks are looking a little expensive right now. Remember, FIIs are always on the lookout for the best deals, the best bang for their buck. So if they see other markets that offer similar growth potential but at lower prices, they might decide to shift their money there instead. It's like going to your favorite chai stall and finding out they've suddenly doubled the price of your go-to masala chai. You might love that chai, but you'd probably start looking around at other stalls to see if you can find a better deal, right? That's what FIIs are doing. They're exploring their options. But it's not just about India and the US. The global economic landscape is always shifting, and lately, there have been some interesting developments. The US economy, for example, has been performing better than expected, which is attracting even more investment dollars. And then there's China, which has been implementing stimulus measures to boost its own economy. All of this creates a sort of gravitational pull, drawing investment away from other markets like India. It's like a game of tug of war, and right now the US and China are pulling a little harder. And speaking of the US, let's not forget about the Federal Reserve, aka the Fed. They've been pretty clear about their intention to keep raising interest rates to combat inflation. Now, this hawkish stance, as it's called, has further complicated things for emerging markets like India. Higher interest rates in the US make it more expensive to borrow money, which can slow down economic growth in other parts of the world. It's like the Fed is turning up the heat, and while it might help cool down inflation in the US, it could also make things a bit uncomfortable for other economies, including India. And speaking of inflation, India's been grappling with its own inflationary pressures lately. You know, the rising prices of everything from groceries to fuel. This is a double-edged sword for investors. On the one hand, it can sometimes signal economic growth, which is good. But on the other hand, high inflation eats into corporate profits. Think about it. If a company has to pay more for raw materials and labor, their profit margins shrink. And when profits shrink, it can make those companies less attractive to investors like FIIs. And unfortunately, this brings us to another factor that's been weighing on FII sentiment: disappointing corporate earnings. In recent quarters, several major Indian companies haven't been able to meet their earnings expectations. This can be a red flag for investors, as it suggests that the company's growth might be slowing down. Imagine going to your favorite restaurant and ordering your usual dish, expecting that same amazing flavor, but then it arrives and it's just, okay. Not bad, but not great either. You might start wondering if the restaurant's quality is slipping and you might be less likely to go back as often. That's the kind of feeling some FIIs are having about certain Indian companies right now. Now let's add another layer to this already complex situation: political uncertainty. With elections on the horizon, there's always a degree of uncertainty about potential policy changes. And uncertainty, my friends, is not something investors generally like. It's like trying to navigate a busy marketplace with a blindfold on. You might eventually find what you're looking for, but it's going to be a lot more difficult and potentially risky. FIIs feel the same way about political uncertainty. Here's another thing to keep in mind. Sometimes FIIs decide to sell their holdings simply because they've made a good profit and want to cash out. It's like selling a property that's gone up in value. You're not necessarily selling because you think the property will lose value in the future. You're selling because you've made a good return on your investment and want to secure those gains. It's entirely possible that some FIIs are doing the same thing with Indian stocks, especially after the significant gains the market has seen over the past few years. And finally, let's talk about volatility. The stock market is like a roller coaster with its ups and downs, but lately the Indian market has been a bit more like a roller coaster on steroids. The India VIX index, which measures market volatility, has been on the rise, indicating greater price swings. This increased volatility can be unsettling for investors, especially those who are more risk-averse. Imagine you're on a roller coaster and suddenly, the loops and drops become more intense. You might start to feel a bit queasy, right? That's how some investors feel about this increased volatility in the Indian market. So there you have it, folks. These are some of the key reasons why FIIs are pulling out of Indian stocks. Now, it's important to remember that the market is constantly evolving. What goes down often comes back up, and vice versa. This isn't necessarily a time to panic, but it is a time to be informed and strategic. Do your own research, consider your risk tolerance, and make sure your investment decisions align with your financial goals.